Hey, this is Sasha Evdokov, and thanks for joining me here for another trading educational video. Now today what I'd like to do is share with you how to buy a put option. Now this is a great video for you to watch if you're looking to just get started in trading options or investing in options, or you have some basic questions about options. We're not going to cover everything about options in this video. It's just a quick little insight to just getting started at looking how you would place a trade to buying a put option. So first off, let's go on screen to understand what a put option is and when do people use it and why you may want to purchase a put option. So what is a put option? Well, when you're buying a put, it means you are looking for the stock to go down, which is basically bearish. It means you have a slight bearish position. Now, if you're a seller of a put, it means you're looking for the stock to go up, which is bullish. So don't get those two things confused. In this video, we're focused on the buying side of buying a put, and it means you're looking for that contract to go down, the stock to actually go down. So that way you make a little more money from the put contract. And ultimately, that's what people do when it comes to trading options. Why would they want to buy a put? Well, basically, if you own stock, right? Let's say I own 500 shares of Netflix and I want to hedge it or protect it. What I may want to do is buy a few put contracts. So that way, if that stock goes down, at least I make a little bit of money on the puts, because the puts aren't going to fully replace me getting out of the stock, right? It's not going to totally negate my position. It'll only protect a little small part of it. And you can do one put or two puts or three puts. Typically, it's based on lots of 100, right? So if you do one put, it covers 100 shares. That's just the way option contracts work. But if you have 500 shares of, let's say, Netflix, and you want to only protect 1 or 200 shares, you could just get 1 or 2 puts, which will cover 100 or 200 shares in terms of protection. So ultimately, that's what a put is it's a downward exposure in a subtle way. Here's a quick little cheat sheet for you if you've never seen this before. It gives you some insight to if you're a buyer of a call, you're looking for that stock or equity to go up. That's your outlook. If you're a buyer of a put, you want that stock to go down. Now, if you're a seller, things actually work a little bit backwards. Okay, if you're a seller of a call, you actually want that stock to go down. And if you're a seller of a put, you want it to go up. But that's beyond the scope of this video. In this video, we're looking at how to buy a put option. So buying a put option means we're looking for a downside exposure. So if we look at a risk profile picture and what that looks like, here's what it looks like for when you buy a put. Now, if you're not familiar with this and how to use this, here's a quick little lesson. So on the left side over here, I basically have either a profit or loss depending on if I'm above or below this zero line. Okay, so that's my zero line. On the bottom over here, I have the price of the stock. Okay, so when you look at this profit line, the black line is the line at expiration because contracts have a certain time frame of expiration. And this pink or purple line is the current today line. And with time, that line gets closer and closer to the black line. So if we break this apart and start evaluating and looking at, well, where would I be at a $20 strike price? Well, if you bought a put, you'd be in the profitable range. Okay, if that stock continues to go lower to, let's say, the $15 range, again, you'd be a little bit higher in terms of profit. But if it gets into the $30 range, you actually be in the losing territory. If it goes in the $40 range, again, you'd also be in the losing territory. So that's how you read this profit picture. And when you look at buying a put, you can see the direction that you're based on and focused on is really you want a downward move in the stock price. And you want to do it as quick as possible because that pink line is getting closer and closer to the black line. So let's look at how to buy a put option on screen or on a trading platform. So here in this example, I have a paper trade account here with Netflix. This is the Thinkorswim platform. I have $2,233 in fake money profits, and I'm going to use this here as an example. I have 100 shares. So what I'm looking for is, here's my basic analysis of where I'm at. Now, I got this stock, okay, right around this price point. You can see this red hash mark, or the 129.72 price level. Okay, so that's what it is on the price. Okay, now with time that stock moved up, and now I am profitable $2,233. Okay, so it allows me to, I could go ahead and fully cash out of this position, or if I believe Netflix still has a longer potential for the future, I could hedge it or protect it by buying a put contract. So what I can do is go into Netflix, and I could say, well, I want protection for about 60 days. And I could say, well, I bought it at 130-ish. Okay, so if I want to protect it at 135, I could go ahead and buy a single contract somewhere around there. It'll cost me a little bit for that protection. Okay, so let's take a look here. So this protection will cost me $279, right? You can see that, multiply it times 100, $2.79 times 100 is $279. So here I'm spending $279 to protect my profits, which puts me at the $135 level. So if this gets to, let's say, 110 or 0 or $5, I can put that stock to someone at that $135 level. That's what the put allows me to do. Now, in general, what most people do is, when you have this kind of position, if I just had the put, and let's just say the stock price goes down to 140 and it goes down tomorrow, let's say $10, at least I make $314 in profits from this put contract. Now, it's not going to offset the full difference of what I lose, okay, because here I'm at $314 in profit, right? But I'm going to lose much more of that actually in the regular stock, but this helps compensate me a little bit for that loss. And that's what puts ultimately allow you to do. So if you look at the stock position, okay, and I go to 140, right, my profit would only be $1,011. Compare that to $2,233. So I'm basically losing about $1,200 if that stock goes to 140. But if I have these puts, okay, if I have one put, remember, I would make up $314. So the reality is I wouldn't be at 1,011. I'd probably be at $1,350 in terms of negative, which is still, you know, I'm still losing quite a bit of money, but it's not as bad, right? So I make an extra $320 or so by holding on to these puts. Now, if things really become a disaster, of course, at expiration, I could go ahead and put that stock to someone else, and that's another approach or way of doing it. And if you combine these things, you know, you can see that I'm still going to be always profitable at least $250 at expiration, simply because of where my price is already. Now, for many people, they just simply go on and buy a put, so they don't even look at, you know, owning the stock. That's not, you know, uncommon. So if I look at Amazon and I'm looking to just buy a single put, right? So I'll go ahead and let's just say buy a 950 put. I could go ahead into the 950, analyze the trade. And now as I'm looking and evaluating this, you can see right there, here is my initial price that I'm starting at, right? So it's basically that zero line right there, okay? So if this stock goes down to 910, I would be profitable about $4,000. If it goes up, since it's a put and I'm buying a put to, let's say, 1060, I would be at a loss, you know, right around that price level. So if I move the mouse at 1060, you can see I'm at a loss of about $1,500. And if it goes down to $900, I'm at a gain of about $4,500. Okay, so that's ultimately what a put allows you to do. And in order to, let's say, place this order, what I can do is just right click, confirm and send, and there are all the details right there. And all I have to do is hit the send button, submit it, and it's going to go into the queue and put on that trade for me. So I'm basically risking $2,300, right? Because it's a $23 put, multiply times 100, hence the $2,300. And that's that green line at the bottom. That's how much I'm risking. Now, the potential that I can make from here, from this $2,300, is if that stock heads down to, let's say, 930, 940, I make $2,300, which is basically I make whatever I risked. It's a 1-to-1 risk-reward ratio, which is fantastic, and that's the power of options. And if it goes down to about 900, which for Amazon's a 90-point sell-off, it could happen in 4 or 5 days. It probably wouldn't happen in one day, but it's possible. You make about $4,000. Now, that's just seeing the money spotlight. Keep in mind, you're also losing theta time and time again. So with time, that white line will get closer to the green line, and you're going to be losing money each day that stock or option stands still. And within a couple of weeks, you could be down about $1,500. So keep that in mind as you're trading or buying put contracts. Thanks for joining me for another training video about options. And if you want to see some of the in-depth training videos, some of the courses that I have available, and some of the books that I've written over the last few years, go to my website at tradersfly.com and take a look at some of that material. Because in those courses, we go into multiple hours about option trading, and we get very specific in every little detail. Now, if you want to join me on a live Q&A webinar where you can ask the questions and I'll answer them, or just share you some insight on the current market conditions, then click this button right here, and when you get there, enter your name and email address. That'll put you on my newsletter list, and when you're on the newsletter list, you'll get those special announcements, promotions, and also the insights to where you can register for those free live classes. Thanks again, and I'll see you next time.